Hello and good morning. Welcome back to Genesis. This is Mike. As longtime readers will know, this chart has been a setup for a screen we've been using throughout 2014 so far, in preparation for what we had hoped would be a fairly significant opportunity window of. Unfortunately, opportunity matches with sell-off, and the crowd was nervous and terrified, and of course, by these pictures, it appears that the sell-off lasted for exactly 8 trading sessions, and now we've bounced back like a golf ball when you drop it from a building. And the question is, was that it? Now, obviously, no one knows the future, but let's see what the tea leaves tell us as we look through these footprints, if you will. In your morning notes this morning, I had noted that the one thing that is somewhat disconcerting and will likely be discussed ad nauseum in the next few weeks by technicians and bears and those that want to sell fear about our future. Let's get a setup of this screen. To your far left, where my mouse is moving around, you'll see the pointer is on the DIA chart. That's the Dow Jones Industrial Average ETF, the diamonds. In the middle is the broader market. We call that the spiders, or we use the spiders as a definition of the broader market. That's the ETF for the S&P 500. And of course, on the far right is the Qs. As many know, that's the NASDAQ 100. Growthier, often perceived as more aggressive names, obviously associated with the tech sell-off and tech bubble, which is now 14 years old. No pun intended. Here's the interesting thing. You'll notice that, just so you know, here's the start of the year. Follow my cursor here in the middle of the screen down at the bottom. Start of the year, and each one is noted. As you can see, 14 started with a sell-off for all 3 indices. Notice that we had previously talked about how the volume spiked and how that often denoted fear in the footprints of the data. You'll see that all of the overbought, oversold indicators went from overbought down to oversold, and of course they have all bounced back. But what's interesting here is the difference in the way the indices have acted. And is there anything we can take from that? Now remember, we have long argued that, I'm squeezing this time frame of this chart up, and I will suspect that we could all agree now that this long move in the Dow, fairly steep as with all averages, was attributed to, or could be attributed, to be perfectly fair, could be attributed to that beginning inkling of people who left the fear chamber of, I only can buy bonds because they're the only thing safe for me. That was the recall, that was the mentality at the pit of the financial crisis. Bonds were the only thing that was safe. Of course, unfortunately, bonds are the very vehicles that all of the countries were going bust over, or perceived as going bust over, and had to restructure. So I'm not quite sure why everybody thought they were the safest, but of course, U.S. bonds were deemed supreme. Interestingly, the Dow's movement, obviously it's the big names, it's the household names, it's the names that if you're even possibly going to get shoved out of the fear chamber of only owning bonds, the best thing you might be willing to buy is the big names, the ones you're comfortable with, the ones that you drive down the street and see them on the signs, and importantly, they pay dividends. And of course, that's the Dow 30. Obviously, a lot more stocks pay dividends, but my point is the drive or the thrust of an indice is, or an index is its main components. So here, the Dow, the big movers of the economy, the big names, the household names, the names your mother told you about, They sold off more percentage-wise. Don't be afraid too much by the picture, because the depth of the picture is changed by the perspective of the picture. But the point to this is that their sell-off was actually steeper than the other indices sell-offs. Remember, they were all generally marking the breakout back in the summer and November time periods. We had noted before that that was resistance and had created a trade range all the way back to May. And then they broke out, and they came back. And we had drawn out these channels as targets of where you might see buying step in to prove support for an ongoing environment of positive markets. Notice that of the three indices, the Dow came below its trade range. The S&P here in the middle came right to, literally to the tick of its bottom of its trade range. And of course the NASDAQ never even got to its trade range. And then vice versa, the bounce in the Dow, and if I showed you the transports, of course, they'd look a lot like this. The bounce has not come back to the highs. And of course the S&P is ticking right up at its highs and trying to, as we speak, break away. And the NAS has spent the last 7 or 8 days above its previous high as it began the year. So you can see the different character of the way these markets look. Now, as I say, bad news bears are going to say, oh my God, that's a divergence. That's something you've got to be terrified of. That is all bad news. And of course, listen, it could indeed turn out to be bad news. We should know that shortly. If it is bad news, I suspect we go back to the bottom of the trade range, which is where we were, 20 days ago. Well, not 20 days ago, I take that back. It's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 14 trading days ago. So I suspect there's something different being suggested here, and that is that as the selling moved out of the big names, it clearly supported the growthier side of the market. More capital went into the growth side, hence the price rose higher than the safe household names paying dividends. So there is another alternative to, oh God, this is terrible, and that is that it might actually be an inkling of a sign that the masses and the massive capital amounts of money that have stayed on the sidelines and or immediately left after 8 days of selling, as you recall, they set records a few weeks ago in mutual fund liquidations of all types, ETFs, mutual funds, domestic, international, emerging markets. That 8 days was enough to instill stark raving terror in the minds of the masses, and they called their brokers and sold. Now, the data show all that, but the question are the indexes showing us something more positive? I suspect that we're going to find out that a combination of things is taking place. First of all, the economy is getting soft data because, unfortunately, we're in part of the country that has suffered through a rather bitter cold winter. And when trains don't move and planes don't move, the industrial part of this country slows down. And when people don't move around and get things done, the industrial part of this country slows down further. And if people don't get in their car and get to the mall, which they usually do, but they won't in 3 feet of snow, then retail sales will slow down. It's slow motion. It's not, oh my God, all of a sudden everything went wrong and it happened to coincide with all the snow. So we suspect this is going to thaw, and as you can see while I'm speaking, the indices are moving into the green. Now, but what does this tell us? There is a thought here that we could be witnessing capital moving out of the big safe names and into the broader market, and supporting, God forbid, shall we dare say, growth in the future. Remember, we all got completely mystified by that horrible 8-day sell-off. I'm going to turn this into a weekly chart, and I want you to tell me where the sell-off is in the grand scheme of things. This is the bottom, and the Qs were down at $31, and they're now at $90. And we had a little teeny sell-off right here that lasted all of 2 weekly bars, and then it bounced right back. So think about that for a second. I will go on record again as stating that I hope we are in for more chop than this. I hope that wasn't the correction that the entire world had been waiting for. I hope that we get another opportunity at being able to sift through some real fear. But I realize at the same time I'm using the word hope and an opinion are two very expensive things in a market, or can be very expensive things in a market. So I'm going to suspect that we may have to recognize the fear we've had for a year and a half now, and that is that all those things we had built into our minds over 12 years of garbage in the market has left a singed pattern that is almost subconscious in our expectation. We hear the word correction and we think, oh my God, that's a few months long, and that's 20%. Nobody registers correction with 8 trading days and 6% down. That's a normal market environment. But we have all been sent through the ringer so many times that the psyche has been permanently programmed for this feeling of the term correction meaning very scary things. I'm afraid that we're watching the corrections and what they'll look like for the next 10 or 15 years. Maybe that was the correction. The next few days are going to tell us this market is either going to have tested its breakout and that's it, or it's going to give us 1 or 2 more shots in a trade range. So let's keep a close eye, and we'll have another video review for you shortly. Hope this has been helpful. Talk soon.